Yo, what up, guys? Welcome back to Fitbiz Podcast. Jordan here to talk about the funnest thing that you could possibly imagine, and that is numbers. Dun dun dun. Look, I used to really hate the idea. Sorry, I used to hate the idea of like having to look at numbers. I would avoid it like the plague. I would often not even check my bank account, like my business account, and I wouldn't even know or care how much actual money I was making, let alone what I was spending. And if I could go back in time, I would have just faced that resistance so much sooner and learned the basics, because most of us have to like learn the hard way before we actually realize how important this is. All right, so don't even just take it from me. I heard Mark Cuban talking about this recently, where he's like just stressing the importance of just understanding basic accounting and finance and marketing, because marketing is a lot of just numbers and data as well. You can pull together quickly the ability to make a decision, the ability to see a problem before it's actually a problem, and to just use this as a competitive advantage to be able to grow a company, especially when you think about your peers and your competitors. Not many fitness business coaches like numbers. A lot of us have terrible money mindsets. We come from very middle class families and perspectives, or low income. And so we like avoid looking at numbers, which is just insanity, because we're, without the ability to track your performance in your business, it would be kind of like starting a weight loss goal, but being like, man, I'm too afraid to look at the scale, and I'm too afraid to look at like nutrition labels. I don't want to see any of that stuff. Okay. I just want to kind of go by feel. That is a terrible strategy, right? We would never do that with a nutrition program or a weight loss goal or a muscle building goal. So why do we think that operating inside of our business is any different? So that's where I'm going to share with you today just a basic system, three-step system to understand the general health of your business from a P&L standpoint, which means profit and loss. Okay, so this isn't going to be overly complicated. Anybody can do it. Even if you don't understand how to do basic subtraction and addition, you can understand basic accounting in your business. Okay, so the first thing to understand here is that there are two different types of accounting that you want to that you have in your business. You have what's called GAAP accounting, which is basically just generally accepted accounting principles, and then you have what's called tax accounting. So your tax accounting, that's where at the end of the year you're going to, calculate everything in your business. Like you're going to go through your bank statements, or if you have a business credit card, and you're going to report that to the government to show, here's how much money my business earned, my gross top line revenue. Here are all my expenses. And then whatever is left after that is what you're going to be taxed on. So with your tax accounting, you want to look as not profitable as possible. You want to be taxed on as little money as possible. So that's why you really got to do some diligence around writing as much as you possibly can off in your business so that your taxable income is as low as possible. We actually made this mistake just last year where, we kind of just didn't really plan accordingly. And we had to write a check to Uncle Sam for $500,000. Now in 2023, we have a really good tax plan in place, and we're gonna probably earn about twice as much money, but we're projecting to only pay taxes on like a small percentage of that. Our tax bill will probably be like $100,000 on twice as much income, just because we had like really good tax accounting. But where you're at right now, like if you're not to like $1 million yet, it's still important, but it's it's a lot less complicated. You just want to make sure you're writing everything off, everything. The air you breathe, you should write off. But with GAAP accounting, this is more so like your back of napkin math accounting that you should be keeping track of in your business, where you want to use to make decisions. You want to use to look at the real health of the business, because tax accounting is a little skewed, right? It's going to make you look not profitable, and that's what we want. So anyways, here's what we're going to do. We're just going to jump right in, all right? So the three numbers that you should always be aware of in your business, okay? These are P&L numbers. Number one, gross revenue. Number two, gross profit. Number three, what are your operating expenses? Which operating expenses are just your labor, your overhead, and marketing. Then that's going to give you your net operating profit, which is more of like that GAAP, like profit number you want to look at regularly. Then you have your net profit. Okay, so I'm going to break each of these down. So all gross revenue means is your total income. It's the total amount of cash collected your company has earned in a given period of time. Some people will also call this top line, but gross income does not account for expenditures, right? Such as labor, overhead, or marketing. This is like total top line revenue. And make sure you don't say like, you're contracted. that's just something that a lot of business owners will do. They'll be like, we had a, $500,000 month. Well, really you contracted 500,000. You collected 200. It's not the same thing. So anyways, that's gross revenue. Now, gross profit is the next thing down from that. So gross profit is the profit the business makes after deducting all costs related to delivering the product and service. So all that means is like it's gross revenue minus your fulfillment expenses and plus cost of goods sold. In our business, we don't really have cost of goods sold. That would be more of like if I'm selling a widget, like like if I'm selling supplements, I have costs in those supplements. But we're selling like information, accountability, and service. So the costs that we have are in what we're paying our coaches to fulfill. That's if you have a team with coaches. So if it's just you and you're a solopreneur, your gross margins are probably like 100% because again, you're not paying anybody to fulfill that. It's you, right? So anyways, what you want to look for is anywhere between 70 and 90% gross margin. 70% is okay. And it'll work, especially if you have if you don't need to spend as much on marketing, right? Like you don't need to run ads or anything else, then like you can get away with like 70%. It's fine if your retention is strong. 80% is super healthy. 90% is like really good. But that also might mean that you're maybe undercompensating your team on fulfillment, right? Maybe you don't have the best coaches. They're a little underpaid. So that's why when we have coaches come to us who are, paying their assistant coaches 70% of contract value, they're already upside down in business. That's not a business. You're running a nonprofit because you're paying that coach 70% and you still have marketing expenses, overhead, other labor. At the end of the day, you'll end up being like, you'll probably end up losing money, right? Because again, like it's just not enough margin to go around. It's insanity. So don't do that. So here's an example. Let's say in January, you did $35,000 in gross revenue. Let's say you paid your coaches $110 per client. That would be $6,490. Your gross margin left over is $28,510. That would be 81%. Because the thing here is as you scale, that number that you have left over, 28,510, you're still going to have commissions to your assistant coaches. If they're doing back-end sales, you're going to have incentives. You're going to have operations staff. You're going to have salespeople. You're going to have, all these other expenses that have to be taken from what's left over. And, you as the business owner, you should make money, right? Because you're taking all the accountability. You're taking all the risk. You're probably doing most of the work. It's your business. You should make more money than your coaches or than your employees. But many people end up in a business where their employees make more than the owner, then the business is losing money, which is not good. So that's an example for gross revenue. So the next thing we'll cover here are operating expenses. These are like the ongoing essential costs of running your business, different than capital expenditure. I'll tell you the difference here. So operating expenses, all that includes in that is going to be labor, marketing, and overhead. Okay. So, and I'll break each of those down in a second, but when it comes to capital expenditures, those are other things that you'll calculate for your net profit. Things like tax write-offs, investments back into the business, like mentorships or coaching or new technology. Things that you don't have to spend every month just to run your business. But your operating expenses, you do. You need to have labor expenses, marketing, and overhead. And if you cut those things, then the business can't operate. So that's the difference between the two. All right. So what goes under labor? Basically, that's everything. So that includes your coach's salaries. What we calculated in gross margin, you're also going to include that. You're not going to count it twice, but that goes under total labor. So you have your coach's salary, your marketing, labor, if you have that, any contractors, sales, operations. You just don't count your owner's salary through this, all right? With marketing, that's going to be your ad spend and all of your referral fees. Every referral payout you make, that's a marketing expense, okay? It doesn't include any labor. It's just what you're spending to attract and to get customers. Then overhead, what that's going to count is like your processing fees through Wave, software, subscriptions, all that kind of stuff, all right? So generally speaking, you want to try to keep your labor expenses anywhere between 25 and 35% of total revenue. We're in a very labor intensive business, different than, again, like a supplement company. They can't have 25 or 35% labor because they also have cost of goods, right? So they're selling goods where we're selling service. Service is people. So that's why your labor expenses are going to be a little bit higher than a product-based business. All right. So, here are the ranges. 25 to 30% is like really strong and healthy. That's where you want to be. 30 to 35% is okay. You know, as long as your team is performing, they're freeing up your time and bandwidth so you can grow the company and they're doing well, cool. 40 to 45%, it's not very sustainable. But it might be necessary for short periods, like if you invest in some team members that you know are going to pay off, but it's not going to pay off day one. So maybe you have a couple of months where you're, you know, a little bit labor heavy. But that's fine as long as you know you're investing in the future of the business growth. So in general, look for, you know, again, between 25 and 35%. So marketing expenses, okay? Let's say that your total income for January was $35,000. Now, most of you listening to this, you're probably not spending on marketing, which is fine. You can get away with that for a while, but for most people, you're only going to be able to get to about, you know, $20,000 to $40,000 months before you're going to end up kind of capping out and not having like a predictable acquisition strategy. Now, if you have a super large audience, you know, we have people in IFCA who've hit $100,000 months organically, but that's because they have a really big audience and they're doing great. But like, you don't have to have a big audience to get to $20,000, $30,000, $40,000 months organically. But at that point, you're going to have to shift your focus and start spending on marketing eventually. So let's say in January, we did 35 grand and we spent $450 on IG shoutouts. And then we did another $1,200 on IG Facebook ads. And then we paid another $900 for referrals. Okay. So our total marketing expense is $2,250. That's 7% of total revenue, which is really, really good. You want to think about it as like, if you're spending 0 to 5% of total revenue, unless your organic is crushing or you're like early in your business and you haven't hit your first 10K month mark yet, you're probably underspending. You probably need to invest some in marketing. Now, if you're at like 5 to 10%, it's pretty healthy. Now, if you're at like 10 to 20%, that's cool too. That means you're aggressively spending or to scale. Now, hopefully if you're at that 10 to 20% mark, you know, and you're seeing your ROI, right? So anyways, general marketing KPI is like 20% max, but you know, if you have an organic audience, 5 to 10% is probably good until you're really ready to scale. Okay, so let's look at the last thing. This is overhead. So your total overhead here, you want to try to keep like less than 5%. Maybe up to 10%, but that's just a little heavy. You just don't need that much in your business. So let's say your income for January was $35,000. You're going to pay about $980 in processing fees. Okay. Then let's say you have another $410 in software, right? Trainerize, you know, Calendly, Zoom, whatever software you're using. So your total expense is $1,190, which is 3.9% of total revenue. So you're right within range there. Okay. So try to keep that around, you know, under 5%. So to break this all down, what we're looking at is this. Our January revenue was 35 grand. Labor was 9,890 or 28%. Marketing was 2,550, 7%. Overhead was 1,190, which is 3.9%. So our total operating expenses for that month are $13,630 or 38%. That means that we have a 62% net operating margin. That's a really strong position to be in. Okay. You're 62% on net operating. So now you can take money from that and reinvest it back into the business. So now that's where we go to look at like net profit. Okay. So net profit is basically income minus operating expenses and minus capital expenses, all your write-offs, your owner's salary and taxes. That gives you your net profit. Okay. So what are the other expenses that you might reinvest back into the business in the form of like capital expenditures? Okay. Think about professional development, masterminds, like all that kind of stuff. Maybe new funnels you're building or media projects or infrastructure you're developing, right? So again, these things can all be cut if your margins aren't doing very well. You don't have to have these things, but if you're able to get to like 60% or even 50% net operating margin, now you can take another 20% of that and invest it back into the business to grow the business. And you're still really good as far as net profit goes. Okay. So as far as net profit, you want to look for anywhere between like 25 and 40%. It can kind of vary depending on the business model and how much you want to work, right? And how much you're willing to reinvest back into the business to grow it, to grow a bigger cash flow asset. If your objective is growth, okay, then focusing on your net operating income is important. And, you know, like if you're at 50%, I would think, okay, why don't I invest like 20% back in masterminds and coaching in, in media projects or whatever. So maybe you're at like 60 to 70% net profit, and you're cool with that because you're working a lot. It's, you know, you're kind of a solopreneur. You want a lean team. You can keep like 70% or 60% net profits, but you're probably not going to grow very fast. Okay. Because you're not hiring, you're not taking the risk to scale, and you're not spending to scale, which is fine if that's what you're cool with. Like, hey, I just want to make an extra $10,000, $15,000 a month on $20,000 total revenue, and I just want to keep the business right here. But again, it's hard to retain good talent that way. It's hard to grow a company that way. You got to be okay with not growing if that's kind of your mindset. All right. So yeah, here's one more way to think about this is I want to show you 3 different business models and allow you to kind of choose which one is most appealing to you. So let's say business model A does $1 million in revenue with 250,000 net profit. Okay. What that means is you have about a 25% net profit margin. So that's 20,833 take home. And it's like, okay, if you're cool with that because you have more freedom and you know by the time you get to like 2 or 3 million, you're really going to be crushing it. Where business B, let's say you do 500,000 in revenue with 400,000 in net profit. That means you have 80% net profit or 33,000 per month take home. So that's a business where it's like you're probably going to be working really hard. You're probably going to be working a lot, but also earning more money, right? As a total function of the business, where now you're earning more on 500,000 in revenue than the other business model was on $1 million, right? That's why like total revenue or gross or whatever just isn't that important. I'm more concerned with like what you're profiting, you know? Or maybe you do business C. This is a really good business model where you're doing 500K in revenue with 250K net profit. That's 50% net margins. So you're taking home 20,000 every month, but you're reinvesting a lot of that back into growth. So I can guarantee next year, you're probably going to end up being like $1 million with 50% net profit, which is a really healthy way to look at it. So hopefully this made sense. And yeah, just start keeping track of this. All you have to do is at the end of the month, just run the numbers. Okay, how much did I spend here, here, and here? There's my total revenue, here's my gross profit. And you just look at it every month and you know, oh, I'm actually super profitable right now. I could reinvest back into hiring people or, you know, spending on marketing. Like that allows you to make these decisions on what the business actually needs to grow rather than you just doing things because you're bored. Okay. Or because, well, this is what other people are doing, right? That's how businesses just remain stagnant. Cool. That's all I got for you. Hopefully this was useful. If so, let me know and I'll see you on the next one.